Well, ladies and gentlemen, welcome back to Boss Economics World, the only show that takes the dismal science of economics and turns it into a full-blown tragicomedy. I'm your host, the one, the only, the guy who's been yelling at central bankers since before it was cool, yours truly, the Economic Avenger. Today, we're diving headfirst into the clown car that is the Federal Reserve's Jackson Hole Symposium of 2025. Buckle up, folks, because this is less of a symposium and more of a circus, complete with tightrope walkers, fire breathers, and a certain orange-haired ringmaster trying to fire people over mortgage drama. Let's break it down, from the surface-level shenanigans to the deep, dark economic abyss lurking beneath. Spoiler alert, it's a mess, and you're paying for it. Let's start with the main event, shall we? Picture this: Jerome Powell, the Fed chair who looks like he's aged 20 years in the last 5, steps up to the podium at Jackson Hole. The crowd is buzzing, the coffee is overpriced, and the air is thick with tension, and not just because of the altitude. Powell's got a problem, folks. Actually, he's got two problems, and they're pulling him in opposite directions like a medieval torture rack. On one side, inflation is still above the Fed's sacred 2% target, yep, that magical number they worship like it's the Holy Grail. On the other side, the labor market is starting to wobble like a Jenga tower after one too many drinks. What's a central banker to do? Hike rates to crush inflation and risk a recession? Or cut rates to save jobs and risk inflation spiraling out of control? Decisions. Now, let's zoom out and look at the data, because here at Boss Economics World, we don't just rant, we prove. According to the latest Bureau of Labor Statistics report, the Consumer Price Index in July 2025 clocked in at 3.4% year-over-year, stubbornly above the Fed's 2% target. Meanwhile, core inflation, which strips out volatile food and energy prices, is even worse at 3.8%. And here's the kicker: the Producer Price Index, which measures wholesale inflation, jumped to 4.2%, a clear sign that price pressures are building up in the pipeline. Translation? Inflation isn't just knocking on your door, it's kicking it down and raiding your fridge. But wait, there's more. On the labor market front, things are getting dicey. The unemployment rate ticked up to 4.6% in July 2025, up from 4.1% a year ago, according to the BLS. Job growth has slowed to a crawl, with only 114,000 jobs added in July, well below the 200,000 monthly average we saw in 2023. And here's the cherry on top: the labor force participation rate is dropping, meaning fewer people are even bothering to look for work. Why? Because they're fed up, folks. The economy's giving them the cold shoulder, and they're saying, fine, I'll just binge Netflix and eat ramen. So, what does Powell do? He signals a rate cut in September because apparently, the Fed's solution to every problem is to throw more money at it. But here's the problem, and it's a big one: not everyone at the Fed agrees. Two governors already dissented at the July meeting, and if they cut rates in September, others might dissent in the opposite direction. It's like watching a family argument at Thanksgiving, except instead of fighting over the last slice of pie, they're fighting over the fate of the global economy. Pass the popcorn. Now, let's talk about the elephant in the room, or should I say, the orange-haired elephant in the room. That's right, folks, Donald Trump is back, and he's got his sights set on the Federal. You see, Trump doesn't just want lower interest rates, he wants to control the whole darn central bank. And he's not subtle about it. While Powell was giving his keynote speech, Trump was busy tweeting, or should I say, Truth Social ING, that he'd fire Fed Governor Lisa Cook over some mortgage fraud allegations. Mortgage fraud? Really? This is the Fed, not the Wolf of Wall Street. But hey, why let facts get in the way of a good political witch hunt? Let's be real here, this isn't about mortgage fraud. It's about power. Trump's been trying to put his stamp on the Fed since his first term, and now he's got a second chance. He's already tapped Stephen Miran, his Council of Economic Advisors chair, to fill an open slot on the Fed board. And with Powell's term as chair ending in May 2026, you can bet Trump's got a short list of loyalists ready to take over. Why does this matter? Because the Fed is supposed to be independent, folks. It's not supposed to bend the knee to whoever's in the White House, whether it's Trump, Biden, or Ascension AI overlord. But independence is hard to maintain when you've got a president breathing down your neck and security guards in military fatigues patrolling your conference. And speaking of security, let's talk about the vibe at Jackson Hole this year. Picture this: Fed Police, U.S. Park Police, Teton County Sheriff's Office, all decked out in military-style gear, carrying weapons, and looking like they're ready to storm a bunker, not protect a bunch of economists talking about inflation. They even had to escort out a Trump supporter, James Fishback, after he confronted Lisa Cook in the lobby. Folks, this isn't a symposium, it's a scene from a dystopian thriller. All that was missing was a dramatic voiceover saying, in a world where central bankers are under siege. Now, here's where things get really spicy. The Fed's decisions don't just affect the US, they ripple out to the rest of the world like a tsunami of economic chaos. Take the Eurozone, for example. After Powell's speech, the euro strengthened by 1% against the dollar. Sounds great, right? Not so fast. A stronger euro means lower inflation in the Eurozone, which is already projected to fall to 1.6% in 2026, according to the European Central Bank. That's below the ECB's 2% target, which means they might have to cut rates even further, risking a deeper slowdown. And if the US economy slows down because of the Fed's rate cuts, guess what? Europe's economy slows down too, because the US is their biggest trading partner. It's a global game of dominoes, folks, and the Fed's holding the first tile. And let's not forget about emerging markets. Countries like Brazil, India, and South Africa are already struggling with high debt levels. Global debt hit a record $307 trillion in 2024, according to the Institute of International Finance. If the Fed cuts rates, the dollar weakens, which sounds good for these countries because it makes their dollar-denominated debt cheaper to pay off. But here's the catch: a weaker dollar also means higher commodity prices, like oil and food, which fuels inflation in these countries. It's a classic catch-22, and the Fed's decisions are the match that could light the fuse. Now, let's zoom out even further, because here at Boss Economics World, we don't just skim the surface, we dive into the deep end. What's really at stake here isn't just inflation or unemployment or even Fed independence. It's the entire framework of how we think about monetary policy. Powell unveiled a new framework at Jackson Hole, scrapping some of the old language from 2020 that was laser-focused on low inflation. Why? Because the world has changed, folks. Back in 2020, the Fed was worried about deflation, prices falling, people hoarding cash, the economy grinding to a halt. But now, we're in a world of persistent inflation, supply chain shocks, and geopolitical chaos. The Fed's old playbook doesn't work anymore, and they're scrambling to write a new one. But here's the problem: the Fed's new framework is vague. It's all about maximum employment and stable prices, but what does that mean in practice? How do you balance those goals when they're pulling in opposite directions? And how do you do it when the White House is breathing down your neck and the global economy is hanging by a thread? These are the questions the Fed needs to answer, but instead, they're stuck in a political circus, arguing over rate cuts and mortgage fraud. It's like trying to perform brain surgery while riding a unicycle and juggling flaming torches. Good luck, Jerome. So, what does all this mean for you, the hard-working viewer who's just trying to pay your bills and maybe, just maybe, save for retirement? First, brace yourself for volatility. If the Fed cuts rates in September, expect stock markets to rally because Wall Street loves cheap money, but don't be surprised if inflation spikes again, eating into your purchasing power. Second, keep an eye on the labor market. If unemployment keeps rising, it's not just a statistic, it's your neighbor, your friend, maybe even you. And third, don't ignore the political drama. If Trump succeeds in turning the Fed into his personal piggy bank, it's not just an economic problem, it's a democratic one. Central bank independence isn't sexy, but it's the only thing standing between us and economic chaos. Here at Boss Economics World, we'll keep watching the circus, calling out the clowns, and breaking down the madness so you don't have to. Until next time, keep your wallets close and your skepticism closer. This is the Economic Avenger, signing off.